Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com, that is where I dive deeper into investment opportunities. We talk a lot about a lot of things that people have questions on. Physical metals, we talk about portfolio allocation strategies, we talk about portfolio setups, how to set it up. We talk about companies, we talk about the presentations of those companies. We dive into the technicals, the fundamentals of the sectors. We do all sorts of stuff. So if you are highly interested in learning about investing, I think this is a great community to join. Use discount as the coupon code if you'd like to join. So here's me posting a ratio. This is oil to NASDAQ ratio. And I wrote in there, how are they going to put this back in the box? So what's going on here is crude oil is starting to break out, and it's starting to break out against a lot of different asset classes. One of the asset classes that I track that I think is a big deal is this ratio here. It's crude oil versus NASDAQ. Crude oil goes up under certain market conditions. The NASDAQ goes up under different market conditions. People get confused because things move in waves. So they confuse things where you could be close to a potential peak or maybe perhaps an underperformance for the NASDAQ, while crude oil is in, we'll call it in flavor or in style. It's in its market condition. So looking back in history, when we had a very large decrease in interest rates, the NASDAQ did incredibly well from the early 80s all the way to 1999. In 1999, it bottomed against oil, and oil outperformed for roughly 10 years. That 10-year mark was from 98, 99 was the ultimate bottom in here, and then it peaked in 2008 for this ratio. So we wanted to be in the NASDAQ from 82 to 99. We swap from 99 into oil and ride oil all the way up to 2008, which much easier said than done. We're looking backwards, 2020 vision, but somewhere in 99, 2000, and somewhere around 2008, if you can hold on that long, that would have been the ultimate trade setup. In 2008 or 9, you wanted to go long in the NASDAQ all the way to about 2020. In 2020, you wanted to swap your NASDAQ for oil. And if you had chosen the companies in April of 2020, you had some 30 to 50 baggers that occurred in a 2-year period from 2020 to 2022. From 22, we had a nice big consolidation. We'll zoom in on this bullish oil here. We had this big consolidation that has just recently broke out. So oil is still in its bull market. These move in waves as inflation comes in waves. And I think that with oil outperforming the NASDAQ here and the way that this pattern looks, we are about to resume the bull market of oil basically doing very well against the NASDAQ. So this is a big deal here. It is a big deal because money is rotating differently than what it was before, and we are super early in this move. So there's a lot of opportunities in oil right now, more specifically even energy service, that I think could benefit from this ratio move. Now, people are going to doubt this move because we're very early. They're not going to believe it. And that's that we're in that part of the cycle where there's disbelief and doubt. The commodity bull market will be doubted, all of that stuff. So we're still in that disbelief phase in this big market. We're not in euphoria for commodities. We're not in any of that stuff. And that still could be, it could still be some years away before we get to that type of euphoria type can't think of the word right now, emotions or feelings of the market. So here's oil to gold ratio. It says this breakout has deeper meaning because it says something about the market conditions that we are in and what will come. So the way that I view this is we had a gigantic bull market in oil from 99 all the way up to 2008. The ratio broke out of this gigantic falling sideways wedge, I'll call it, sideways wedge. It broke out and it outperformed gold for a period of time. The market conditions changed from 2008 onward, where gold outperformed crude oil. During this time frame, this is when the NASDAQ and S&P do incredibly well. But in 2020, that changed. The bottom of that market changed, where we came on up and broke out of the falling wedge of crude oil to gold ratio. We have been consolidating in another falling wedge, just like we saw earlier against the NASDAQ. And here we are breaking out of crude oil versus gold. We are breaking out right now of this ratio. So what does this mean? Why is it such a big deal? It tells us about the condition, the market condition that we are in. And I didn't read any books on this, guys. This is all me looking at data. I could probably write a book on it. It's all me looking at data. And since I have an engineering background, I look at tertiary effects. What drives what? What is the root cause? Or what are some leading indicators that can tell me what is happening before everyone else wakes up? Ratios can tell me that because if you understand what does well under certain market conditions, and in other market conditions, other things do well, you can be earlier than everyone else. And I think what was the saying in that one movie? Be first, cheat, or work harder, or something like that. There was three. I'm working on being first on all of this. So I'm in early. I can sometimes be in a little bit too early, but that's the cost of getting really cheap prices. You have to be emotionally stable. You gotta be able to hold through. And then when this stuff turns, I have the most amount of cheapest shares that I can grab at that bottom, we'll call it. The bottom that's in these corners here, or these false breakdowns. I can buy these things because I've got the cojones to do it, and I've got the reasoning and logic behind all of these, where you come off the page for cheap oil, and then you come and you break out. This here nets you, if you choose your companies properly, it can net you between a 10 bagger and a 50 bagger in a 2-year period. Because you're buying stuff that is so out of favor under fear that nobody wants it. And then you're going to be sitting there drowning in shares as people throw shares at you if you're one of the few buyers. And then we've got another second best opportunity that's starting to come right into fruition in front of our eyes, in my opinion. The oil market, Javier says, the U.S. is quite likely to refill the depleted strategic petroleum reserve under the incoming administration. Chris Wright, Donald Trump's nominee for energy secretary, told reporters on Wednesday they're going to fill up the strategic petroleum reserve with what oil? I mean, guys, we're gonna tighten this. We're gonna go to $90, $100 a barrel, and then maybe they open the taps for OPEC. If OPEC doesn't open the taps, how are they going to refill the strategic petroleum reserve? Why did they dump it in the first place? Oh, that's right. They were manipulating the price of oil lower, which would essentially manipulate the price of the consumer price index lower. So inflation went away when they opened the taps on the strategic petroleum reserve. So wait, did they really fix the inflation problem? No. They didn't fix the inflation problem. So what's going to come in front of us? Probably inflation. Global LNG demand is forecast to nearly double by 2050. Look at this, guys. 2023 to 2050 by region. Up, 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 up. You think that's worth investing in? Do I know any investments that are going to benefit from this? Yes, I do. And we entered it in the beginning of 2024. And guess what that's up? Over 100%, maybe even getting closer towards 200%, depending on where you purchased it. And if you purchased the exact bottom, uh, you are now over, no, let me think. You're a little over 100%, about 150, 160%, probably not over 200 is where we got that bottom. And this is coming ahead of us. And we also have a lot of cold weather that is right on top of us. We are going to probably draw down inventory levels, and it's going to shoot natural gas prices higher. The difficult part is we can't respond that quickly with production. I know they've been drilling holes. They've been doing drilled uncompleted wells. Um, we've got some of those that have been built up in natural gas. Some of the companies have been doing that. So there'll be some response at a somewhat quick period. But we'll probably see prices respond to the upside, and then some of the drilling companies may increase production a little bit. And here's the thing. Gorian Rosenzweig thinks that natural gas production is pretty close to peaking. We have a whole slew of LNG terminals coming online this year. If we've peaked, this is going to be a very interesting thing for natural gas. That's what I'll say. It'll be a very interesting setup, if that is true. Christine Guerrero says, thank goodness for these product builds. Crude and storage keeps draining. Refinery demand above average and storage below average for everything. Crude, Cushing, gasoline, and distillates are all below average. Crude oil inventories below, motor gasoline inventories below, distillate below, Cushing crude below, and total U.S. refinery demand, slightly above average perhaps there for refinery demand. Coming down, Warren Buffett says an investor needs to do very few things right as long as he avoids big mistakes, says Warren Buffett. U.S. commercial crude storage is starting the year near the multi-year lows. There we are. So the 5-year average is way above it. We've got 2022 that was pretty low in the green there. And now 2025, we're tracking right where 2022 was. Nick says the core CPI rose 0.23% in December, lowering the 12-month rate to 3.2%. The headline CPI rose 0.39%, pushing the 12-month rate up to 2.9%. That's what we've got for the consumer price index. Now, when the consumer price index, this is going to follow what the producer price index does. And I bet you the PPI is going up. That's my guess. Gold to oil ratio dropping like a rock. There we are, dropping like a rock. So we're seeing oil outperform gold here. It looks like a shoulder head shoulder when you price these, differently than before. We had crude oil versus gold. Now it's gold versus crude oil. And that's dropping to the downside where oil's outperforming. Big deal here. OPEC keeps 2025 global oil demand growth unchanged at 1.45 million barrels per day. So that's a pretty big growth. We'll see if Shale's up to the task. If it isn't, let's squeeze this inventory level, which will increase prices until OPEC opens up the taps a little bit. And we'll see how much spare capacity they've got. It says you can only pick one, an 850 credit score, a $5 million cash, $6,000 a week. What would I choose? I would choose $5 million in cash. I could give two craps about an 850 credit score. I don't need that. My credit score is really good, and I don't need that. I already have a good credit score. So why would I need that? $6,000 a week. I mean, that's good, but $5 million cash is better because if you get the money up front, I can invest that cash. I can make, if I were to invest that in some of the stocks that we have, I bet you I can get an average yield of about 15%. So 5 million in cash times 0.15 can net me $750,000 a year divided by 52, which is actually $14,423 a week. So that's what I would do with it. I'd take the 5 million in cash. Now there's another thing. $6,000 a week isn't worth that much because you are going to get money out in the future And when you discount that money back to today's dollars, $6,000 5 years from now is not worth as much as the money that you'd be getting today. So you could do a discounted future cash flow of $6,000 a week, add it all up, discount it back to today using different interest rates, and you could see what the net present value of $6,000 a week is. 5 million in cash is the most valuable because you have the most amount of purchasing power today with that cash. Then what I could do with that cash is invest it and put it into a high dividend paying portfolio, which I basically am doing already in these commodity companies that are in favor, in oil stocks and energy service stocks and dry bulk and tankers and all these different things. And I could probably earn $750,000 of dividend income on that. So that's what I would choose, and that's what I would do, and the reasons why I would do it. An 850 credit score is absolutely worth nothing to me. If I had $750,000 for cash, I could buy a house in 1 year if I really wanted to, if I just saved the dividends up. Yeah, I see no reason. I already own a house anyway, so I guess it really depends on your situation. Um, but I think everyone should choose 5 million. There's no reason to choose 1 and 3. SRS Rock Report says when we go to data, then we can see that the only growth in silver mine supply came from byproduct copper production. Primary silver, byproduct gold, byproduct zinc lead all declined from the global peak of silver production at 900 million ounces in 2016. Guys, we have a problem in silver, and we are eating through silver inventories rapidly. Our deficits are around 250-ish million ounces a year. This is going to be a big problem. Here's my projection. Silver is going to go way up, way, way up. Some of the companies are going to get scared, and they're going to start to buy mines. They're going to start to buy mines, perhaps. So I think silver is a great investment opportunity here, and everything looks good from a fundamental and technical perspective. Josh Young, commercial flight activities up 10% year over year as commercial flights continue to suck down the jet fuel. Tavi says the irony, oil, gold, silver, copper, platinum, palladium, natural gas, agricultural commodities are all rising as government inflation data shows signs of deceleration. Gotta love that. Gotta love that. Those lagging indicators are so great. Grady says GDX gapped above the blue line today. As long as we're above it, it is a breakout. And that trend line is also the weekly cycle trend line. So not only a daily cycle low should be in, but also the larger degree weekly cycle low. So they're looking at this, and if we get weaker yields and a weaker dollar, I do think that miners, they could really move along with gold and silver. They could move. David Murrin says the crypto Bitcoin bubble is about to burst. We have long argued that Bitcoins and the crypto market's growth is a market bubble occurring in the context of the decline of the US dollar. So that's his opinion there, even though the charts do look pretty strong here in the short term for crypto, in my opinion. Unusual Whales, Generation Z is unprecedentedly rich, per The Economist. Millennials were poorer at this stage in their lives, so were baby boomers. So I don't know if that has to deal with the market conditions. When I first started, we had that big, I worked for a couple of years. I started in 2005, 2004, 5. Late 2004 is when I got my job. I worked all the way through, and I saw the tail end of the commodity bull market, and then we went through 2008 crash. I didn't know nearly as much as I do today. I wish I could go back and do it again and work my way through that. I would, oh my goodness, I'd have just ridiculous how I would do that. I would I would have accumulated stocks in 04, 05, and commodity stocks. And then I would have sold in 2000, probably 7 or 8, if I knew what I knew, but I didn't know how it would play out. Let's say I don't know exactly, but I just knew the information that I had today. We saw the housing market roll over in 06, 07. 07 is probably where I would get out. I probably wouldn't have nailed the top, to be honest. Um, Probably would have sold a little bit early in oil. I probably wouldn't have gotten the 2008 peak. And then I would have purchased the living crap out of '09, the bottom there. '08, '09. And I did that as well, but I could have maybe timed things a little bit better if I knew about the real estate cycle back then. Eric Nuttall says U.S. energy independence is a fantasy, and Canada is a critical component of U.S. energy security, especially with the twilight of shale to tariffs, reliable and cheap source of irreplaceable crude oil is lunacy. And again, this is just showing shale production growth that is topping out. And remember, we had that 1.54 demand growth. So 1.54, they have 1 million here. So it's actually up here is demand growth. And we've got this big gap that exists between shale growth and the 1.54 that's up here. There's that white area. That's going to eat through our spare capacity if they decide to bring on spare capacity. They'll eat through it. So it's going to get real tight here in oil over the next few years. And then I don't know what happens in year 2026. Because if you have 1.54, it's going to eat through about a little over 1 million barrels of spare capacity. We will eat through another over 1 million barrels of spare capacity. And that's probably about all that we've got for spare capacity that we want to eat through. If we start to get to about 2 million barrels or lower of spare capacity, I think oil is just going to go ballistic. It's going to start to go ballistic in 25, 26. 25 will be a strong year. 26 and 27 will be ballistic years. And then I don't know what happens after that. We could get a recession. We could get a huge pullback in that. And then I don't think that we'll get oil growth. We'll have to find alternatives. And that's where things get real muddy, is out in the late 2020s. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.